Oh, as had my mic muted there, but it is noon. We'll get things started. My name is Jasper with Score Maine. I'm joined today by Nate Henry of Kennebec Savings Bank for a presentation on business bank loan application tips. If you weren't familiar with us at Score, we are a resource partner of the Small Business Administration. We help clients from all stages of the business cycle, from free start to exit. And I want to thank Nate for putting on today's presentation. We look forward to your questions as they arise. If you have a question, you can either queue it up in the chat or raise your hand utilizing the function in the React window, and we can have you come off of mute. Um, Either way, we are recording today, and the recording and slides will be sent out once it's available and after we wrap up at the end here today. So I'll start screen sharing in just a second, and we can get the ball rolling. All right, how's that look?
Looks good to me.
All right.
So we can kick it off and go to the next slide. But thank you all for joining today. My name is Nate Henry. I work with Kennebec Savings Bank. I'm going to talk a little bit about what it means to apply for a business loan, some things that we look for. I've been in banking now for coming up on 7 years, primarily focused in commercial banking throughout that time. So please ask me any questions. Happy to give nondescript examples of things. So if people have specific questions, I find that helps people get a better understanding of what we're talking about. Bankers are synonymous with large acronyms and terminology that only ever makes sense to other bankers. So if you catch me using any of that language, please stop me, and I'm happy to explain it in more human terms. But Score is an incredible resource. I've been really fortunate to work with them in this way a number of different times and have referred many clients to Score in the past. So a little bit about me. Most people don't aspire to banking. Banking kind of finds you. So I grew up in the Bangor area. My family had a small business. So I grew up around that entrepreneurial spirit, seeing them work within the business, and knew that I wanted to work with people that had that similar drive and that similar passion. So when I was at the University of Southern Maine, moved down to Portland, see the big city. I was really fortunate to start my banking career with Bangor Savings Bank, where I spent a number of years and did some internship with the Maine Small Business Development Center. So we'll probably talk a little bit more about the Small Business Development Center in the future. Fortunately, in the state of Maine, there are a lot of really great resources, whether for advising or for financing. Unfortunately, a lot of business owners aren't aware of all the programs available to them. And it's people like me that get exposed to the different resources. So, your lender should really be a partner in your business and helping to connect you with the right resources. So I would say that's the biggest thing. And if that's the main thing you take away is, if you're working with a bank, they should be helping you through the process, telling you what you need, but also helping you develop what you need if you don't have it. And Maine Small Business Development Center, as well as SCORE, are great resources for that. I serve on the board for the Portland Regional Chamber of Commerce, as well as a few other nonprofit boards. They're a great resource for advocacy for businesses and exposure. We've partnered on a number of ribbon cuttings for certain businesses. So certainly your local chamber can be a really great resource for you as a business owner. In addition to that, I volunteer with the Portland Development Corp. So the Portland Development Corporation is a lender based here in Portland. They have funds that have been revolving from the Finance Authority of Maine. All that doesn't matter. Essentially, what they do and the value they provide is they work with banks and directly with small businesses to provide loans in this instance that a bank can't provide a loan or the bank needs some additional funding. So if the bank can only get comfortable up to a certain amount, let's say a construction project and things run over or whatever the project is, but there's a gap, the city of Portland is happy to come in and help fill that. So another great resource if you're building your business here in Portland. So yeah, that's a little bit about me. What might be helpful too is if people want to throw out into the chat just to get a read of where people are coming from on today's call. If you are someone who works with business owners, if you're a current business owner, if you're looking to start a business, if you want to just kind of put that kind of phase of where you're at with things in the chat, that might be helpful in guiding the conversation.
Yeah, we had a few introductions in the chat already. One from Ryan. Ryan and his wife run RNZY out of Alna. Martha is looking into buying an existing small business. And Ryan says they've owned the business since 2017. TT is looking to start a restaurant in the greater Portland area. The business Martha is looking to buy is in Oob. And Jeannie is one of our new mentors here at SCORE. Mary is owning and operating MSR Auto in Wayne, and Elizabeth Johnston owns Sweet Tooth Fudge in Gray.
Awesome, that's great. Well, it sounds like a lot of business owners and some that may be in that.
Looks like you're unmuted, but I can't hear you, Nate. Oh, there we go.
Can you hear me okay now?
Yes.
That was weird. Hopefully that's the only technical difficulty we have. But anyways, no, that's great. So it sounds like a lot of existing business owners, which is certainly helpful. So here's a little bit about what we're going to talk about. But again, people can reach out into the chat or just interrupt me with any questions or things that they want to talk specifically about. Or we do have a lot of existing business owners. I'm sure you've dealt with a number of challenges within your own business. So happy to, discuss that. So with that, we can move on to the next slide here. Great. So seeking funding. A lot of businesses can get started without the use of financing, though given how expensive everything has gotten, it's becoming more and more common to see financing being a part of most small businesses. And that can play a role whether you're leasing space or if you're looking to purchase real estate that your business is going to occupy. In addition to that, you have a number of different existing businesses that people have thrown out here. So I'm sure equipment needs and startup capital needs may be higher in the auto industry than they are for a restaurant. But if you're operating an auto business, you're likely going into space that is outfitted for that type of business, where the owner of Sweet Tooth Fudge, you may be in a space that you needed to put a lot of money into to make it fit your needs. It could have been a number of different businesses before you encountered it. So we can go to the next slide here. So I think one of the most important things, and it sounds ironic, is to really understand and know your business before you're going in and applying for a loan. And what that means in terms of knowing your business is knowing how a bank may be looking at your business. So a good example is Martha, who's looking to purchase a business. So she's looking to purchase a business. It's been in existence. Common sense would tell you that is not a startup. However, when you're applying for financing, any change of ownership does cause banks to look at the project as a startup. Fortunately, I have a lot of experience in working with people acquiring businesses or starting new businesses. So it's not something that banks won't do, but there's some additional things that we're going to need to look at. It sounded like there's a number of people that are in this phase where they're working on their business plan, putting together projections. A great resource for that is SCORE. So I refer people to SCORE to work on their business plan, work on their financial projections, to get a strong understanding of their business. What I think gets lost upon people is that the business plan, when you're working on that, should not feel like just a task to do, a to-do task for the bank or for the lender. Even though it's something that we're going to ask you to provide and something that we need for you to apply for the loan, the business plan really should be a living document that as your business grows, as it changes, you are reassessing that business plan. So I was talking with someone the other day who's been in business for 10 years, However, when they first started, they had one location. They now have nearly 10 locations. What it takes to manage 10 locations is very different than what it took to manage one location. The staffing needs, the marketing needs, the economies of scale. So even though their business has been around for 10 plus years, I really pressed on them to develop a business plan to really articulate how they got to where they are now and what they're looking to do in the future. Are they looking to go to 20, or are they looking to grow in other ways? So, the business plan is an important piece of most businesses. I did see a specific question here. Yes, we can talk a little bit about what banks are going to look for in applicants as we go through, Ryan. If there's anything specific I'm not touching on, feel free to jump in and we can discuss. But I think a business plan is an important part of most businesses, whether they're existing or in that startup phase. But certainly if you're new to business, a business plan is probably the first step for you. And we can move to the next slide. So yeah, as we talked about, startup versus established. Typically anything that's less than 2 years old in terms of tax returns would be considered a startup. However, if you're applying for a loan to purchase a business, what we really want to be able to see is this is what the business has done financially in the past, and here's my expertise and what I'm bringing to the table. Even though, so we have a lot of people that are in business here, you may or may not have borrowed in the past. I think it's important to articulate the key differences between personal lending and business lending. So fortunately for me, I found my way into business lending and really enjoy that space for this reason on why they're different. If you're looking to purchase a car personally, you can really analyze someone's income, their credit score, and really determine a likelihood of whether or not they're going to pay back that loan. It doesn't matter who I am per se. If my income and Steve's income is the same, even though we're very different people. We live in different areas. We have similar income. We have similar credit scores. We're probably just as likely to pay back that loan. On the business side, it's completely different. Your business's success is really going to be driven by your expertise as a business owner, as well as your industry knowledge, where you're located, the timing of your business. Those are such important factors in your business's success that I think can't be understated. So yes, a business model may work, but are you the right person to bring that business to fruition? And, it's important in the business plan stage to identify the gaps. I think we are all, you're not going to be masters of everything. And I think the biggest misconception is that when you're going in to apply for a loan, you need to know it all. You need to be, the head of marketing, the head of HR, the head of operations. And the reality is it's a lot to ask of one person. And it takes a lot of different skill sets to make a business successful. So I think it's really important to be able to articulate, here is my background. Here are the skills that I'm bringing to the table and what I see my role in the business being. And here's how I'm going to fill out those other gaps. Does anybody have any questions regarding that piece of it and how it's different? A big saying in the commercial and business banking world is that it depends is probably our most common answer. And the reality is two businesses are never the same. Even if they seem on paper like they would be similar, everything is going to be dependent based off of your situation. So don't be discouraged or frustrated if you hear that. It's very common. And I think that's why the business plan is so important. Also, interacting with your banker earlier in the process. If you're considering applying for financing or have an idea that, hey, I'm growing the business, I encourage you to reach out to a local lender, ask them to take the time to sit down with you, because the better that they understand you and the better they understand your business, they're going to then be able to tell that story to our underwriters and senior management on why we should do a project. There is no such thing as a no risk project. But we as the bank are successful when you as the business owner are successful. If we're just meeting for the first time, it's hard for me to really be able to articulate your skill set, your background, your experience, and why this project is going to be a success. So I think it's important to be able to sell yourself, and that happens through getting to build those relationships. That's why I like my job. Most conversations that I have with business owners take place many, many months, if not years, before they ever necessarily need me for the financing. That's not to say that I certainly meet with people that need financing pretty quickly. So, but I would say a lot of conversations are more long-term and really just trying to build that relationship. So that way, when that person has a need for financing, I can say, oh yeah, I remember they said that this was their goal in 6 months, and 6 months have gone by and they've done X, Y, and Z to work towards that goal. And it just allows me to share that, oh, they're not just trying to expand the business overnight. This has been a thought out plan. We've been in communication. So it just makes it an easier process. So we can move to the next slide here. I'm going to read through the chat just for a moment to see if there's anything specific we should hit on. Yeah, this is exciting. I love seeing the different projects that people are working on. So, Ryan, to your point, having that team around you is incredibly important. And viewing your banker as a part of that team is a mindset shift for a lot of people that haven't borrowed for their business before. But once you can establish that relationship, it certainly makes things a lot more. It makes things smoother, makes things easier. So yeah, some things to consider. Working with your CPA, a bookkeeping team. A bank's going to want to be able to see your financials to get an understanding of your business. So that's going to be a mix of historicals as well as some projections. Especially if you are in a growth phase and you're looking to finance growth. And growth can mean a new location. Growth can mean hiring some new employees, and you want to use some debt to be able to expand your team. It can be purchasing real estate where you had previously been leasing. It can be equipment, a number of different things. Your balance sheet. Do you have any debt currently? I will be the first to tell you, business credit cards and credit cards are debt. Now, if you're utilizing a credit card and paying it off every month, you'll want to notate that. I've worked with business owners in the past, and it is not a knock towards them, but I think that it's not always considered as debt. But we're moving along in the process. Things look really good, and we find out that the business has a couple $100,000 worth of credit card debt. That certainly causes us to pump the brakes. Now, in this scenario, it went through me. Everything looked really good, and then it wasn't until it got into underwriting when the credit card debt came up. Now, the business owner pays off that credit card every month. So they didn't think to tell me about it. It didn't really mean it's not debt to them because of the way that they utilize it. However, if I was able to, just add that little footnote when I sent the package off into underwriting, it would have saved a couple days worth of timing. And, underwriters are meant to be skeptical by design. It helps to protect the bank. It helps to protect business owners from getting into situations where they're not able to pay back the debt. That being said, if they have to look at something multiple times and, here's my note, and here's a note, and here's a note, and then we're answering them, over another couple weeks span, it definitely does not help the process. So the more that we can have a clear picture of what we're presenting to underwriting or a credit committee, the smoother the process is going to go. So tell us everything and trust that your lender is going to help refine that information and get it into the hands of the right people. A big part of anyone who's putting together projections is including assumptions. If you're writing a business value in your business plan, or you're basing a certain number of sales, what are the assumptions around that? you're projecting XYZ in sales, but what is your pricing based off of? What are you imagining for your hours? Assumptions are one of the most important and one of the most forgotten pieces of any sort of business projection. So are you anticipating growth in one sector of your business? Are you scaling back another sector? Similarly to if you're purchasing a business, you may say, okay, I'm purchasing a business, but we want to do more of X and less of Y because it's more profitable. So you want to include that in your those assumptions in your projections, that we're going to be actively scaling back this part of the business that is staff intensive, and we're going to be increasing the volume of this business, which has better margin. So that's why, even though last year the business did $1 million in sales, we're projecting 1.5 and less in expense. Those situations all happen and they make a lot of sense. But if we just see the projections, it's harder for us to make those. We're not going to be able to make those assumptions for you. So yeah, what you said, Ryan, that's perfect. That is an assumption that is worth including as you're putting together projections, because we're not going to know that. And especially when we're doing that analysis, we're not allowed to make any guesses. Everything has to be pretty laid out for us. So even if something, looks like a duck, sounds like a duck, we're not going to be able to take that extra jump without having confirmation from you as the business owner. So the more you can tell us, the better, and just trust that we're going to refine out the things that don't matter and the things that do matter. And business owners that tell us their concerns about their own business, that is not a red flag. That is a green flag. No business is perfect. No business is without risk. So being able to articulate your strengths, but also the things that may be challenging your business is going to be really important for us to understand that, you have a really good understanding of your business, your business. So for the startups question, I would say the best advice I could give you is to work with a SCORE or small business development center in those projections. So the two most important parts of the projections is that there are assumptions included, because that's going to help us understand how you got those numbers. And then the second most important thing would be having them monthly. So if it's just annual and it says you have like 3 expense items and it says, supplies, staff, and this, and then an income, and it's for the year, we're going to look for a lot more detail just to make sure that you're taking into consideration, merchant processing fees, sales tax, if you're paying employees, are you giving them benefits? So we want to just make sure that they're all encompassing. So if you can have broken out projections that include all of the expenses your business is going to face, and you have it on a month-to-month basis, because we are all here in the state of Maine. Believe it or not, there's some seasonality to a lot of businesses in Maine. So being able to demonstrate that okay, in XYZ months, we're going to lose money, but we're going to, make it back, throughout the busy season. That's really important. Someone mentioned a business in Old Orchard Beach. It could be a number of businesses, but let's say it's hospitality. That is certainly going to be impacted from a seasonality perspective. So those, I would say, are the really important things for projections. So feel free to move to the next slide, Jasper. So understanding your ask, what are you borrowing for, and what is it for? So that's a little bit on the sources and uses. It sounded like a silly question to me to ask, but I think a lot of people find it, they've heard terminology used, so they think that they know what they're needing to apply for and how much they need. And a lot of the times that then gets further refined by the bank. But having an understanding of what your borrowing need is going to make sure that you're connected with the right lender. Lines of credit get talked about a lot and typically feel like they're an easier loan to apply for. They can help you grow the business. However, lines of credit really should not be used for any long-term investments in your business. Lines of credit are really meant to be used for things that can be paid off through your typical operational cash flow. So I use I'll use two examples. One will be a contractor and one will be a restaurant. Both have needs for lines of credit, and those needs are pretty different. So if you're a contractor and you're taking on a larger project, you are fronting the cost of both the staffing and supplies for that project and getting paid out over potentially net 30, net 60, net 90 days. Businesses that do contracting with the state of Maine, get paid out over a longer period of time as well. So you're going to get paid, but you have to be able to front those costs. And that can be hard, especially if you're just getting started out or if you're growing and you're taking on more and more of those larger contracts. So in those scenarios, it can be really helpful to have a line of credit that you utilize to cover the gap. So, you may use a $250,000 line of credit or a $100,000 line of credit to get you through those large contracts. You're utilizing the line of credit to pay for materials, to pay, your subcontractors through that time. But when you get paid back from the job, you pay that off in a lump sum. For restaurants, it's very common for them to use a line of credit between really January, but even February, March timeframe. They're typically hiring summer staff prior to the busy months. So they're going to have higher payroll expenses and lower income for those first few months as they're onboarding new staff members. So they may utilize the line of credit in the slow months, but pay that down in July or August as large sums of money come in for the business. Now, for a line of credit that's being used for something that isn't what it's meant to do. Let's say you're growing your business, you want to hire a few new staff members, you want to hire someone in marketing, someone in sales, and you get a line of credit to fund their hirings. Depending on your business, it's pretty uncommon that they're going to be able to pay for their annual salary in year one. So, you expect that person to be a longer term employee. Any sort of investment into your business that you think will benefit you for more than a year probably isn't a good use of a line of credit, but rather a term loan. So this is understanding your ask. I'm just reading in the chat here. So I would say it can be a number of different things. And I would say should or should nots are a really hard thing because, as I alluded to earlier, it all depends. But being able to articulate why you're applying for a line of credit or why you're applying for a term loan, I think it would impress your banker that you understand that the line of credit is really meant to be used for this and a term loan is meant to be used for that. A lot of these questions can be difficult to ask as you're trying to figure out what your ask is going to be. And again, I would encourage you all to work with a local lender to understand that. Unfortunately, I know I've seen it a lot. I know I've sent people to SCORE and they've seen it a lot. There are a lot of online lenders out there, as well as lenders through your point of sale system that will tell you that every business needs a $100,000 or $200,000 line of credit. You can get it in, 2 days, apply right here. Those have put business owners in really difficult situations time and time again. I've worked with a lot of really successful businesses that unfortunately utilize that versus, they took a couple $100,000 loans thinking that was going to fit their need, where really they needed $500,000 loan. But if it was structured the right way, they could have paid for and afforded the larger loan, but unfortunately took the smaller amounts that weren't really suited for what their need was, and it put them in a difficult situation. So, working with someone with the right experience to kind of guide you along that path is sometimes applying for more money. If it's the right situation, makes sense than applying for less money. But if it's structured the wrong way, it could put you in a bad situation. So for a question regarding inventory, that's a good question. And I think it could be a mix of a term loan and a line of credit, depending on, I'm trying to remember what Ryan's business was here. It could be a mix of both because it sounds like you're growing. So, a line of credit may fund what your existing inventory is, but if you're really looking to grow the business, you may want what we call permanent working capital, which would be a term loan. So, I mean, we recently worked with a business that was expanding into Portland. They were previously based in Augusta. And we did a line of credit for them to cover some initial, office supplies, some things as they were building that out. But then we also gave them a larger term loan for 5 years that was really funding the growth. So the line of credit was just to support, their existing operational expenses as they poured more of their cash into growing the business. And then we also provided them some kind of funds to boost that growth. So it can be a mix of both. And working with someone who can kind of guide you along there and saying, here's what I'm trying to do for my business. How do I get there? That's a great question to ask your lender and someone at SCORE or the Small Business Development Center. So we can move to the next slide. So yeah, this is a really great tool to create as you're working through understanding your ask, is a sources and uses. It's going to help the bank understand, what you're going to be putting towards the project and what the total project cost is going to be. So there's a number of different programs. We work a lot with the SBA for the SBA 504 program. So that involves a number of different loans, an SBA loan and a bank loan, and typically some form of injection of cash from the business owner. So I don't fully understand your question, Martha. If you're acquiring a business, like buying them out of the business, we work on transactions like that all the time. So are you referring to like seller financing? Like you're going to be the existing business owner? That's a great, Martha, you teed me up great. So seller financing, that is something that's become more and more common and is something that we view really positively. So seller financing, for those that aren't familiar, is if you're buying a business, the seller is also issuing a loan, typically in a lesser position. So when I say lesser position, I am referring to how what we use for collateral on the loan. So that could be real estate. It could be all business assets, which is pretty much all encompassing of inventory, equipment, anything that you would have on hand as a business asset. So when we talk about subdebt or seller financing, which would be considered subdebt, it's people lending in a lesser position on the collateral than the bank. Does that make sense for people? Again, I said I would try to limit my banker jargon. But assuming that makes sense for people, it's really common, especially because things have just gotten more expensive, that, especially in a business acquisition, you're going to see the owner bringing some funds down, a bank loan, and then potentially a seller loan. You can also see loans from organizations like the Portland Development Corporation, Finance Authority of Maine, CEI. These are all organizations that are comfortable lending behind a bank to help small businesses grow or get started. Now, I just referred to a ton of different organizations that all look for similar but sometimes different things. As the business owner, do not be concerned. These programs are really wonderful. Your lender should really be helping to guide that conversation and connecting you with the right resources. So if you bring up these organizations to see if the bank works with them, that's a really great question, but you definitely don't need to be an expert in all of the different programs. Ideally, your lender is going to look at the project, say, okay, we may look to bring in such and such organization, and they're going to need, X, Y, and Z, but they can help get the project done. This sounds like it could apply to some of you. Another really popular program is the SBA 504 program. And that is a great program if you are, and it applies for if you're buying a business, are a startup, and an existing business. So each one of those types of organizations or statuses could utilize that program. The SBA 504 program is really helpful as a business if you are looking to purchase real estate or a lot of equipment But primarily it's usually used for real estate that you're going to then own or occupy as the business owner. So they look for 51% occupancy or higher. So I'll talk a little bit about this program, then I'll answer Ryan's question. So the 504 program helps put the bank at a lesser position on the real estate, which can get them comfortable taking some additional risk. It can also, if you meet the right criteria, put as low as 10% down. The SBA's loan is also going to be at a below market interest rate typically. So I just went through, it's a relatively complicated program, but there are a lot of lenders here in the state of Maine that have familiarity with it. I just went through it at light speed pace, just given that we have a lot of information to cover. But if anyone has specific questions on the SBA 504 program, I can hang on after this, or you could reach out anytime and we can have a deeper conversation there. So the lender fee, fees and interest, and a number of different things. So there is no set fees for banks. That's going to be bank dependent. So if you ask for a term sheet from a bank, that should include what their interest rate is going to be, what the fees are going to be associated with the bank's loan. Now there can be external fees, such as an appraisal, or if you're getting a guarantee for your loan, whether that's through the SBA or the Finance Authority of Maine, your lender should be able to quote those fees, but they may or may not be on the term sheet. And then I think what Ryan's hinting towards is what we call a prepayment penalty. Again, what the prepayment penalty is going to be dependent on the institution that you're working with. Typically, if you are, if it's involved with real estate, typically the prepayment penalty is charged if you refinance the loan with another financial institution. It can be charged in other situations. That fee is typically based off of the fixed rate period on your loan. So let's say you have a 5-year fixed rate period on your loan. It's a typical structure would look like a 5, 4, 3, 2, 1, meaning it's 5% of the balance if you pay it off in year 5, 4, 3, 2, 1. But those are good questions to ask your lender as you're trying to find out the right partner and just the total cost of what the debt could look like. So each bank is going to be different on that. Fees are typically not included in the sources and uses unless it's a project that involves some extensive closing cost and construction. So when you're looking at a construction project, you look at the interest carry in addition to your closing cost as being a part of the project. Typically for small businesses, it doesn't occur where it usually doesn't reach that level of complexity. The opposite. So I guess in year 1, it would be 5%. So I misspoke on that, Ryan. If it's like the sooner you pay it off in that fixed rate period, the higher your prepayment penalty would be. But typically, again, it's different from bank to bank. You can typically negotiate those. So I wouldn't look at that as a non-starter, just being able to understand your options. Feel free to go to the next slide. So one thing that doesn't get talked about a ton, or I've seen new business owners get a little bit surprised about, is what we call a personal guarantee. So any owners with 20% or more are typically required to provide their personal guarantee on the loan. A lot of people feel like it's only through a startup phase, but this is something that we require nearly all businesses to do. This can change a little bit from bank to bank, but it really is an industry standard on that 20% piece. 20% is typically what's designated as a beneficial owner. So someone who's receiving benefit for the bank or institution doing the loan. So being able to understand this, one thing to note, this does not mean it is a personal loan. So if you're applying for personal loans, such as an auto loan or a mortgage, there's likely going to be a question asking if you're a guarantor on any debt, and you'll want to mark yes, but it is the business's debt. So It should not show up on your personal credit score or personal credit report, and should not impact your ability to borrow personally. We understand that this is a business loan. However, the business is relying on you to operate that business. This goes the same for if you have an entity that owns an entity. If they are closely related, and certainly if there's a shared ownership, it can be looked at for that business to provide their guarantee as well. So being able to understand your credit score, some banks have programs for loans of a certain size, and will say, oh, it's going to be based off of your personal credit score and this. I would be wary on that. They can be a good fit, but as we said in the beginning of this, business lending is really going to be based on your business. So you should work with a lender that's going through that process with you, understanding your business. And certainly credit score plays a factor, but it does not mean if you have a credit score that isn't where you'd like it to be, doesn't mean it's a non-starter at times. So I see this brought a few other questions in the chat here. So let me see. So Isabella, are you asking if the business experiences a bankruptcy, or if the personal owner? Yep. So I would say and then I see apparently I'm using too much banker jargon. So I'll go back a little bit. So the personal guarantee is the owner pledging that if the business is unable to pay the loan, that the business owner is going to utilize personal assets, income to make the bank or lender whole. So it's really the business owner saying that, yes, if the business isn't making payments, I personally am going to make payments, or I personally will work with the bank to make that whole. So if it reaches a stage of that, it's typically looking at what does the business have for assets that can be liquidated. Are there any personal assets that can be liquidated? I don't want to go too much in the weeds there, and I'm not an attorney, but it's typically a full pledge of, and there are such things as limited guarantees. So a limited guarantee may be that you're only responsible for X amount of the debt, or certain assets are not being pledged. So those can be negotiated, but typically you look at an unlimited guarantee, and that owner is, providing that they're going to pay back that loan in the instance that their business could not. So Mary mentioned a negative experience applying for a loan that is utilizing an SBA program. So that is an important thing to talk about. Does anybody else have any additional questions on guarantees before I talk a little bit about SBA loans? This is a really interactive group, so I really appreciate you guys' time, and I hope this has been beneficial. So in talking a little bit about an SBA loan, it's important to note that not all SBA loans are created equal. In the sense, what I mean by that is that the SBA provides programs for lenders to use. However, the decision-making on whether or not to do the loan still resides within that institution. So interest rate is not all, your interest rate on an SBA loan is not going to be the same at, Kennebec Savings Bank as it is Bangor Savings Bank, as it is Machias Savings Bank. They're going to all have their own pricing. They're going to have their own underwriting, and they're essentially utilizing an SBA program. There are guidelines within that, but they're pretty broad stroked to allow banks their own autonomy. There are two primary SBA programs out there that get utilized a lot. So one is the SBA 504, which I talked about a little bit, and I would say that provides a lot of direct benefit to the business owner in the sense of they're getting potentially a longer term, putting less money down, and utilizing a below market interest rate for some of their loans. So I feel like that's a real tangible benefit to the business owner. Again, that program is utilized primarily when purchasing real estate that's going to be owner occupied. Now, the other SBA program that gets utilized a lot, which can be really helpful for business owners, but I would say doesn't provide the direct benefit, is the SBA 7A program. The SBA 7A program is a loan guarantee program. And what a loan guarantee program, the SBA offers one, and then the Finance Authority of Maine, or FAME, also offers one. And that is additional support to the bank that in the instance of the bank or the business not being able to pay, that up to a certain percentage of that loan would get paid back by the SBA or the Finance Authority of Maine. So it's like, I think the best way to describe it is you're essentially paying for a loan insurance policy. Typically, there are fees associated with that. So I think that question came up a little bit earlier. So that fee is payable by the business owner. Now, the difference between SBA and FAME, SBA is a national organization. The Finance Authority of Maine is, based here in the state of Maine. Bangor, when I was a lender there, we utilized the 7A program a lot. And for a while, they weren't charging fees for loans of a certain size, which made that program beneficial. Here at Kennebec, we don't utilize the 7A program. We utilize the FAME program. We found that it's a little bit easier to do the application process for a FAME guarantee. It can be modified on a more regular basis. So, let's say we're charging a guarantee, for while you're considered a startup, but if you can then demonstrate that the business has been successful, we can then look to release that. So even though it may be a condition to start that lending relationship, it can be, taken away in the future, which would then save you on the fee side of things. So Mary, to your point on the SBA thing, it could be a situation where that lender may not be the right lender for you. And, it could be worth talking to another lender. And again, being honest and upfront is always really important when you're looking to start a business. And I would say working with someone who it's really important. I think that we get, I've heard it a lot from a lot of people that like time gets wasted because they're going through a process to apply for something and then, are blindsided when it doesn't work out, and that the lender feels really passionate about it and feels that, oh, this is really going to work out. That can sometimes be an internal thing. It sounds like in this situation, it may have been an SBA thing because there are a lot of SBA forms to fill out. Now, I will say certain lenders have more experience in working with SBA, so they should be able to help, vet you or see if it's a good fit for that program or not. Unfortunately, sometimes people do get burnt out on that. So I would say it's going to be, like I said, my favorite phrase, it depends. Whether the SBA is going to be a good fit for you or if you had one bad experience, it's not always going to be a negative, but can certainly understand that sentiment. Finance Authority of Maine, I think, does allow you a quicker decision making, or offers a quicker decision making process, where SBA is pretty intrusive. So again, the guarantee programs are really great if you can't get a loan without it, where the 504 program, I think, really provides that direct benefit to you as a business owner. So there's a lot of information. I hope that makes some sense. We can move to the next slide here. So we talked a little bit about this. We can move to the next slide. Move to the next slide. So if you want to talk a bit about SCORE, we can also kind of open it up to discussion. I don't know if there's too many more heavily informative slides. So Jasper, if you want to talk a minute about SCORE, then we can move to the next slide, and we can wrap up from there.
Yeah. If you're not already familiar with us here at SCORE, we were founded in 1964 and we run on our volunteer mentors. Many gracious mentors, about 100 here in the state of Maine, volunteer their time to bring you free business advice. If you're not already working with a mentor, you can find one for free at score.org. Enter your zip code and a little bit of info on your business. And I'm actually our client services manager. So anyone in the state of Maine that submits a mentor request goes through me. I pair everyone who comes in. We did get our numbers from last year. Here in Maine, SCORE helped start over 560 new businesses. So if you're not already working with a mentor, again, it's free and confidential, and you can do so for free on the website. And yeah, otherwise, you can head over here, Q&A section. We do also provide many other free workshops throughout the year. Few coming up this week. We have one on how to use AI to boost vacation rentals, which is a new interesting topic for us. I'll include a few in my follow-up email with the link to the recording and the slide deck today. And yeah, if there's any other questions, now's a great time. Well, Martha saying thank you. We did have a cool intro earlier from, I believe we missed from Lionel about importing some coffee from Burundi. I'm a huge coffee fan myself, so any new roasters in Maine are always welcome in my book. From Brian, SCORE does have a business plan template on our website, as well as workshops for that exact topic as well. Just give it a quick search. I can also include it in my follow-up email.
Yeah, my contact info is here, and would encourage, I would love to get to meet with you all and learn more about what you guys are doing in your businesses. I think just finding a lender that wants to be collaborative with you is really important. Yeah, I would say the banks that you're working with are important, and understanding ones that, have a small business focus, tend to be what we call community-based banks. So a lot of the banks that have savings bank in their name are considered mutuals, so there aren't shareholders. They tend to be a really good fit. I know SCORE refers a lot of people to those community-based banks, but finding someone that's willing to have that conversation and think outside of the box, because it's become more and more challenging for you all. So I really appreciate you guys taking time out of your day to join this call. And yeah, you guys are what make my job really exciting.
And hey, we appreciate you putting on a really great presentation today, Nate. It's an invaluable topic that I think, is pretty scary for a lot of people. And I think today helped demystify the process for a lot of people. Well, I want to thank everyone again for attending, and we'll be following up shortly with the information we touched on, as well as recording to the link to the recording and the slide deck. And there's also a link to a short survey we'd really appreciate you guys filling out. I want to thank everyone again for attending. I want to thank Nate one more time for a great presentation, and I hope everyone has a great rest of your day. Have a good one.